Good morning, and welcome to the Leap Podcast, your concise, level-headed crypto market update from Leap Digital Investments. I'm Patrick Penn. It's Friday, 19th of June, 2026. It's been a remarkable fortnight. Two of the biggest macro questions of the year, the US-Iran conflict and the path of US interest rates, have both been largely answered in the past 96 hours, and the market reaction has surprised many. The Iran tail risk is expected to be reduced following a formal peace signing in Switzerland, but Wednesday's FOMC delivered a genuinely hawkish shock that has dominated price action. Bitcoin briefly dipped below 85,000 Aussie dollars or 60,000 US dollars last week, recovered through the weekend, then sold off again after the Fed. At the same time, on-chain data is telling one of the more constructive structural stories of the cycle. Let's sleep in. Starting with the macro backdrop, the US-Iran formal peace agreement is reportedly being signed today in Switzerland after reaching terms over the weekend. Brent crude has fallen more than 5% on the Strait of Hormuz reopening and is now trading around 120 Australian dollars or 84 US dollars. That should be a more disinflationary signal, but it landed in a week dominated by the Federal Reserve. May US CPI came in at 4.2% year over year, the highest reading since April 2023, with energy accounting for more than 60% of the monthly increase. On Wednesday, Chair Kevin Warsh delivered the latest FOMC meeting, and the surprise was sharp. 9 of 18 officials now project a rate hike before year end, rather than a cut. The PCE inflation forecast was raised to 3.6%, and Warsh forward guidance was reduced. Polymarket now prices a 69% probability of zero rate cuts for the whole of 2026. Spot Bitcoin and Ethereum ETFs lost a combined 158 million US dollars on the day of the announcement. That tends to land harder on crypto than on equities for a structural reason. Crypto leans on monetary policy and liquidity far more than the stock market, which still has AI-driven earnings behind it. So, rate hike pricing can act as direct headwinds for crypto, which helps explain why Bitcoin can soften even while blue chip indices sit near record highs. Turning to prices, Bitcoin in trading around 89,585 AUD, broadly unchanged from where we sat 2 weeks ago, but with significant volatility in between. The fortnight low was a brief dip below 85,000 Aussie dollars, the first time since October 2024, with the crypto fear and greed index hitting 11, one of the lowest readings on record. Structurally, the dip looks more like a sweep of the 200-week moving average than a clean breakdown. Price wicked below the line, took out the stops, then closed back above it on the weekly. That's the more constructive reading of the move, not the more bearish one. Ethereum is near 2,496 Aussie dollars, Solana around 101, and the total crypto market cap sits at around 3.17 trillion. Zooming out, the chart is essentially boxed in. The 200-day moving average up near 109,800 Aussie dollars has acted as a resistance since the May rejection, while the 200-week moving average down around 85,560 is support the desk has been watching. The fortnight swing has effectively the full width of that range. On the regulatory and adoption side, the structural picture continues to advance. Stablecoin mentions in SEC filings and investor presentations reached 1,000 in the first quarter of 2026, up from just 40 in early 2023. A clear sign that corporate America has begun to integrate stablecoins into business strategy, following the Genius Act framework. In the most visible consumer-facing use of the US stablecoin to date, the Trump family-backed World Liberty Finance used its USD1 token to pay $357,000 in bonuses at a UFC event held on the White House South Lawn. USD1 now has a circulating supply of roughly 6.6 billion. Separately, the Digital Asset Clarity Act remains on the Senate floor calendar, with the White House targeting a 4th of July signing. Putting it all together, this fortnight has reordered the macro playbook for crypto. The Iran tail risk that dominated for months has eased, but the Fed has stepped into the gap as the dominant force, and the inflation problem hasn't actually improved just because Iran has. It's worth being precise about what a hawkish Fed is telling us, though a central bank confident enough to threaten hikes is generally looking at a labour market still strong enough to take them. Jobless claims remain historically low and unemployment is drifting up only gradually rather than breaking. That may be interpreted more as like a late cycle squeeze than the start of a recession, which may represent a more constructive backdrop than the headlines suggest. And underneath the surface, the record long-term holder base and June's heavy accumulation may point to one of the more constructive structural setups of the cycle, even as the macro overhang weighs on near-term price. Looking ahead, the path back to a more constructive tape runs through one chain of events. If oil sustains a move towards 107 Aussie dollars a barrel following today's peace signing, the disinflationary case builds. That feeds into a cooler July CPI print in mid-July, which often gives the Fed scope to revise its dot plot at the September FOMC. That's the 60 to 90-day window the market is now watching. There's also a longer clock worth keeping in mind. Crypto bear markets have historically run roughly 50 to 60 weeks through high to low, and on a comparable counts, this cycle sits somewhere around week 35, which is one reason many are watching the back half of the year rather than treating the current move as the whole story. Closer in, the Clarity Act between now and the 4th of July remains a meaningful, potential positive catalyst. In summary, this is a period of elevated uncertainty and mixed signals, but with one important shift. The macro overhang has narrowed to a single channel: inflation and the Fed, while the structural setup beneath the surface continues to strengthen. Prices have not yet reflected that divergence, but historically, that kind of gap between weak price action and strong on-chain accumulation has tended to close in the patient holder's favor. Remain calm and stay informed. That concludes your market update for the 19th of June 2026. Check YouTube and Spotify for more information. Thank you for listening to the Leap Podcast.